Good afternoon, everyone. Thanks for joining us today for our fixed income webinar. I'm Howard Almdahl, your wholesaler based in Winnipeg. On the line in Toronto is my business partner, Dan DeCruz, and our featured guest, Mark Wisniewski, who manages the 9-Point Diversified Bond and Credit Income Opportunities Funds. We're going to do things a little differently today. I'm going to ask Mark a series of questions, and he's going to answer and refer to slides from the deck in front of you. These questions have been asked by advisors in meetings we've had across the country. So here we go. First question, Mark. Can you comment on the current level of interest rates in the US and Canada? Could we at some point see negative interest rates?
Hi, Howard, and hello, everybody. So this is one of the, actually, I just came back from a presentation about a couple hours ago. And I think we spent more time talking about the potential of negative interest rates than we talked about anything. So I'm all prepared to basically approach this. And I have what I think is some pretty interesting insights. So if we look at the first chart here, this is just the market implied policy rate. So this is what the market thinks the Federal Reserve and the Bank of Canada are going to do with respect to rate cuts over the next 3 months, 6 months, 1 year, 2 years, and 3 years. But for now, I just want to really concentrate on the next 12 months, which I think is probably critical. So the market thinks that the Fed's going to cut rates a full percentage point. It's interesting, in Canada, it's almost 50, or it's a little bit less than 50 basis points cuts between now and a year, which I think is a little bit ridiculous. I think that if the US is cutting rates 4 times, there's no doubt that Canada will follow suit, because obviously the currency here would appreciate and it would affect everything pretty significantly. So I think that if that happens, the Bank of Canada will have no choice but to cut rates quite a bit as well. So first of all, what we want to point out here is that central banks globally now are all cutting rates. And I think if you go across the world, there's probably been 23 rate cuts in the last little while. So all banks are in the easing mode. So this is the math, and this is a little chart I put together, and this is the way fixed income folks sort of think about when people say, well, where do you think interest rates are going? So the composition of interest rates, and I'm putting this fairly simplistically, is basically composed of 2 things. One thing is term premium, and the other thing is the average overnight rate over the life of a bond, right? So basically, the average expected overnight rate over the life of a bond is obviously impacted by how much the Federal Reserve or the Bank of Canada cuts rates. So that level right now is, call it for the sake of argument, somewhere around 2.6. Now, term premium is something that is added or subtracted to that expected rate to provide you with what the actual interest rate is. Now, if you look at that term premium chart and you go back a number of years, you'll see that term premium back in the 80s used to be about as much as 8%. Well, what's interesting now is primarily because a number of factors. First, we've had low inflation for the last 10 years. We've had lower growth. We've had more savings. We have negative interest rates, and we have a whole number of things that are impacting term premium. So when we calculate term premium, we put all these things together, including a number of other things. We come up with a term premium, which is basically negative 106. So when you add term premium to that interest rate, you get a level somewhere around 1.6 right now, which is exactly where the 10-year rate is. So let's say, for example, that we're right and the Federal Reserve cuts rates 4 times between now and the end of the year. What potentially happens is that expected overnight rate starts to drift down from that 2.6 level. So over time, it's possible that that level gets to 1.6, 1.5. It may even get to 1%. And then when you subtract that term premium, if term premium stays the same, you basically get a 0 interest rate. So all I'm saying is that if term premium stays the way it is, and that's a lot of ifs, ands, ors, or buts. I mean, inflation could go up, but if inflation doesn't go up, things stay the way they are. It's entirely possible that 10-year rates in Canada and the US go very close to 0. And if the economy weakens substantially here, and we have to do things like quantitative easing that they've been doing in Europe, there's a potential that we could go negative. Now, I'm not saying that's a high probability, but what I am saying is that we're in an environment right now, because we're starting to cut rates at such a low level, that we're in an environment right now where interest rates, 10-year interest rates, could go to record lows. That means that we could very potentially have 10-year rates at 50 basis points, or maybe even 25 basis points. Now, the other interesting chart is, and that I like, is this is the number of negative yielding debt right now. This is the number, and it's now just pressing somewhere around $16 trillion. So it's way above where it was a number of years ago. So we're already seeing that the amount of negative yielding debt is starting to push to all-time highs. And what's also interesting about this is, if you think about German rates from 0 all the way out to 30 years are all completely negative now, and France is negative beyond 10 years right now. So this whole phenomenon of negative rates is really catching on in Europe right now. Now, Howard, next question.
Okay, so I guess related to that is, what's the bond market telling you about the state of the economy and the health of economies? But are equities and credit sending a different signal relative to the government bond market?
Right. So this is interesting. So this is a government yield chart going back to the 70s. I have ones going back to the early 1900s, but let's forget about that right now. But if you look at this chart, we're now down to basically the level in interest rates where we were in 2016 and 2011. So what's interesting about this, if we went back to 2011 or 2016, in both of those cases, we were in an environment where globally, all central banks, everybody was of the opinion that we were teetering into a significant global recession. So interest rates are exactly where they were when we had that big scare in 16 and when we had that big scare in 11. So it's interesting, if you look at government rates right now are implying that there's a high risk of recession, or we're going into recession shortly. Now, interesting, here's a chart on US high yield and investment grade spreads. Now, what I've done is I've drawn an average through that, and both of these charts go back a number of years. So, I took averages back to 96 and on investment grade back to 98. It was just based on the amount of data I could get. But I want to talk about high yield first. So if you look at where we are in the average, high yield spreads right now are somewhat very close to the average or slightly below. Now, when I look at that, if you didn't show me the interest rate chart, I would say, well, high yield doesn't think that there's any defaults coming, doesn't see any significant risk of defaults, or spreads would be a lot higher. And simply put, the way to think about credit spreads is they're basically insurance. So when you're worried about things, that credit spread or that insurance needs to be higher. And when you're not worried about things, that credit spread gets tighter. Well, it looks like when you look at high yield right now, we're in an environment where the high yield market isn't particularly worried about the economy. Now, there's one thing I need to point out about high yield. This has been one of the most interesting environments for high yield in a number of years, because there's been record low issuance of high yield. And that's primarily because most high yield companies are now doing loans. And why are they doing loans? Primarily because they can get better terms on a loan. They can get a lower interest rate. They can get looser covenants. They can get more preferable financing doing a loan rather than issuing a high yield bond. So consequently, all of these, or many of these high yield companies, are all going to the loan market instead of issuing high yield bonds. So the problem is, there's lots of maturities in high yield. There's still money in the space, and they've got nothing to buy, so they keep buying these secondary issues, which make the space really expensive. So that's an interesting technical, which you wouldn't typically see now. Now, if we go to the right chart, which is Canadian investment grade, you see exactly the same thing. You see the average, spreads are about on the average of where they've been since 98. So same thing, when I look at that, it tells me that, well, investment grade credit isn't worried about recession either. And what I think is also telling about this is, if you think about quality, the quality of the index back in the 90s and early 80s was much higher. i.e. there was a lot more AAAs in the index, there was a lot more AAs. If you move forward to today, the average quality of the index is a lot lower. So if we actually adjusted that spread, that average spread, it would probably move up to 125, which again, when I look at it, I say if I move the average to 125, again, it tells me that investment grade credit isn't looking particularly cheap now either. So credit, like the equity markets, are saying, you know what? Everything looks good to me. I'm not worried. I don't know what the bond market I don't know what the bond market is stressing about. So it's a very, very interesting, situation right now in that one of them has to be wrong, but I guess we're not sure who's going to be right or wrong yet.
Okay, so I guess another thing to look at is the yield curve, obviously, which is all the talk even in the mainstream media. So you mentioned in your commentary that the yield curve is suggesting that we may go into recession in the next 12 months. So what does that say about the yield curve as a reliable predictor?
Okay, so a couple of things. We spend a lot of attention. We spend a lot of attention on the yield curve. We think about the yield curve. We look at the yield curve. We model the yield curve. The yield curve contains, for a bond person, an immense amount of information. Now, having said that, the chart that I'm showing you right now is the Goldman Sachs Global Leading Activities Indicator. So this is just one of 5, 6, 7, 8, 9 things that we look at to gauge the state of the economy, to gauge the business cycle, to gauge whether credit's expensive or cheap. So first of all, when I look at this, again, what does this tell me? Well, it looks like we're turning down again, and we're headed to much slower growth. I mean, everything in this chart here is telling me that things are weakening. So when we move to the next chart, all of that is just being confirmed by the bond market. So the left chart basically shows you the shape of the 3-month to 10-year yield curve. And as you can see, it's basically going more negative. It's inverting. And then on the right side, you can see that's our recession indicator. So we have a model. We basically base it on the same thing that the Federal Reserve does, and it's showing us the same thing that we're going into recession here. So here's the problem, and there's a few things that we have to think about here. So one thing, if you go in the past and you think about all the recessions that have happened and the predictability of the yield curve, the predictability of the yield curve has been awesome. It's probably been right out of 8 out of 10 times. The problem with the yield curve model is timing's terrible. So if you go back to 2007, we had a recession within a year. If you go back to the mid 90s, the yield curve went inverted and we didn't get a recession for another 3 or 4 years. So its predictive power is great, but its timing is absolutely terrible. So a couple other things that we looked at and we sort of think about. So first of all, we went back and we said, okay, let's go look at this 3-year, 10-year yield curve, but let's go look at it 1 year forward. So in the bond market, there's a forward market. We can look at 3 months, a year forward. We can look at 10 years, a year forward. We can look at every fixed income security, year forward, 5 years forward, 10 years forwards. But we just went a year forward and we said, okay, what does the shape of the yield curve look like according to the market a year forward? And it's interesting that if you look at it a year forward, it's actually steepening again. So the curve goes from inversion back to steepening. So what the bond market is telling you is that, yes, the yield curve is inverted. And apparently, if we get a recession, it's currently saying it's probably a short recession because we're already steepening a year later. Now, the other thing that we should also point out is that 3 months to 10 years is inverting, but 2 years, 30 years is not inverted yet. So the whole yield curve is not inverted. So to me, when I remember recession last time, we got a yield curve which was completely inverted all the way to 30 years out. So we're not there yet. Now, the last thing I want to talk about is, you recall when we were talking about negative interest rates, we talked about term premium. Now, a lot of academics are saying that the yield curve doesn't have the same predictability that it did 10 years ago, 20 years ago, because that term premium is so negative. If you go back to regular markets a long time ago, the term premium was positive, which meant that you had more yield on longer dated securities, which means you had a steeper yield curve. So the argument by the academics is because term premium is so negative, you can't really take everything that you see as gospel with respect to recession indicators. So my final note on this is, yes, we pay attention to it. Yes, we look at it, but I don't batten down the hatchets and say it's time to go home because the model has told me recession. All this tells me is that recession is somewhere on the horizon. I have to be cognizant of it in my portfolio positioning. So because of that, I have to be aware.
Okay, so further on that point of recession, you're not all that worried about it, but what are you doing in terms of positioning your portfolio to prepare for that inevitable recession? And as rates go lower, how does that change?
Yeah, so good question. So here's a little slide that we put together on how we manage, it's a very briefly detailed. I mean, it's more complicated than this, but I wanted to show everybody that we have process around what we do, and we're very active in how we manage our portfolio. So first of all, what we've transitioned from, our portfolio used to look like a lot like we're in a flat environment, which meant we had low duration, we had high investment grade, we had no high yield, but we didn't have a lot of duration. So when the curve started inverting, first of all, that says to us, okay, again, I can't predict exactly when recession is coming, but to me, it's on the horizon. I have to pay attention to it. So one of the things that we did is that we increased the duration of our portfolio. So that was the number one thing. So we're an active manager. So we went from very, very low duration last year because our opinion in 2018 was rates were going higher. They did. We had a duration of around 1 year. So basically what we did is we tilted our duration from 1 year all the way up to 6 years. So we're always transitioning our portfolio to be either on defensive mode or to be on opportunistic mode. And right now we're completely in defensive mode. So we've added duration to the portfolio. We've added governments to the portfolio to create that duration. So to create more duration, we haven't bought longer dated credit. To create more duration, we've bought longer dated government securities because we want a pure play on duration, not with more credit risk. The second thing that we've done is we've sold most of our high yield off. So again, when I look at high yield, it's incredibly expensive. If we're going into recession, I don't want to own a lot of it. And I'll bet you we were 40% over a year ago. We're probably 5% right now. So we've sold off a lot of high yield. And what we've done is we high graded the portfolio. So our portfolio quality has probably gone from BBB to single A. And then the last thing that I think is really important is that we've added liquidity to the portfolio. So probably, I would say within the next year and a half, 30% of the portfolio matures. And if I'm right about recession sometime next year, we have a sell-off in the equity markets, investment grade and high yield sells off, we'll potentially have 30% of maturing product to be able to recycle into higher yielding opportunities. So you probably, a lot of people don't talk about liquidity, but I think, after 2008 and parts of 2016, it's got to be it has to be an important integral part of how you manage money these days.
Okay, so that covers the positioning. Your fund is up just over 5.5% year to date. So how do you generate returns in what appears to be becoming at least a very low interest rate environment?
So, good question. So I want to show you a few slides. Now I want to go talk about a couple of things that I think are interesting, but we'll go all over the place. So first of all, what I did is I said, okay, let's think about an environment. Let's think about an environment where we go to really, really low rates. So on page 12, this is interesting. So what we did is we went to Europe, where a lot of the government bonds are negative, and we said, well, let's go have a look and see what bond funds yield, what type of duration they have, what type of returns they have, and what type of expenses they had. So if you look at the right column, they're all having a fantastic year, primarily because, well, they own most bond funds that represent the aggregate probably own 70% governments. So they're benefiting from that big move into the negative stratosphere. But what's interesting, if you look on the left column and you look at their yield or their income, basically you're getting 29, 28, 43 basis points of income, and you've got 8 years of duration risk. So, and what's also interesting is that you got 29 basis points of income and you've got an MER of 97, which means as soon as you buy this bond fund, if interest rates don't go down, you're locking in a half a point loss immediately. Well, half a point, 60 basis point loss immediately, which I thought was quite staggering. So one of the things that I think we have to talk a little bit about is, so the next chart is page 13. So what this shows you is it's the Canadian bond index, and the gray line going down is income, and the sort of the bluish line going up is duration. And the bottom line, return break even, is basically how much interest rates have to move before you lose money. So if we're right about my thesis about interest rates going lower, what you're going to find is that the yield on those bond funds is probably going to go, if interest rates continue to go lower, it's probably going to go and approach 1%. And if you have 1% income with 8 years of duration, your break even is probably going to go down very close to 20 basis points, which means if interest rates move 20 basis points, you're setting yourself up to lose money. If interest rates move another 20 basis points, you're going to lose money, so on and so forth, because there's absolutely no income in these ETFs, bond mutual funds, to support them. So what do we do and what do we try to do, which is a little bit different? Well, first of all, we like duration, but we like duration in government bonds, not corporate credit. So in a low interest rate environment, you'll be interested to know we're taking advantage of buying government bonds that have more yield because of a couple of reasons. So the government bonds that we have bought are basically, again, and you're not going to be surprised to hear this, we own Germany, we own France, and we own US Treasuries. And I got to go back to another slide to explain this to you, why we own Germany and France. So the interesting thing is, let me find this slide. So the interesting thing is, when you buy a German government bond, because their interest rate differentials are so much lower than us, when we hedge the currency because of the forwards, we actually earn more than we do on the yield on a government of Canada. So you can see when we hedge the German government bond right now, we earn 1.6. When we hedge the French government bond, we earn 1.87. If we buy a Canada, we own 1.14. So we say, well, I don't know, for us, why wouldn't we just own French and Germany, especially if we think those economies are going to be most vulnerable and they're going to go even more negative. So where we've gone is where we think we're going to get the biggest bang for the buck. So interestingly, when you hedge it, you actually get paid more in Germany and France. And the other thing that we have bought has been basically we bought 30-year and 10-year US Treasuries, primarily because they yield way more than 10-year government of Canada's. So when we buy government bonds, we don't just look to buy Canada. And I can tell you right now, of our 35% exposure to governments, I'll bet you 5% is Canada. Everything is outside Canada where we get more yield and it's more opportunistic. So we like adding duration, but we like adding duration with government bonds where we get paid more. And the reason we like 30-year treasuries is because we're getting paid over 2% on them. And if we're right about the yield curve flattening, that's where we're going to get the biggest bang for the buck. Now, the other thing we own is short-dated investment-grade credit. We own double Bs and single Bs. So I know we're expecting to get a little bit more volatility out of credit, but we have to get some yield into the portfolio. So if we buy short-dated investment-grade credit, when I mean short-dated, we buy things that are 4 years, 3 years, 2 years. We get paid way more than we do on a government bond. So we provides ourselves with some income, and because they're so short-dated, we don't feel like we're going to have a big risk of any sort of capital depreciation in the event that we get some volatility. And the other thing is that the amount that you get rewarded to buy a 30-year corporate bond versus a 2-year corporate bond is almost negligible. It's one of the things that's interesting. We were buying Enbridge commercial paper that yielded 2.35. It basically had a month maturity. It paid almost much as the 10-year bond. So we said, well, why wouldn't we just own the commercial paper? Why take the risk at a 10-year bond? Buy a 3-month piece of paper. So we're looking for all sorts of opportunities in short-dated, higher grade credit or higher grade high yield credit to give us more income than government, so we can still have more yield in the portfolio. And then the other thing I talked about is we like to maintain a degree of liquidity. So 35% of the portfolio is short dated. And the other thing that we think is a good way to generate income is avoid owning oil and gas and metals and mining right now. And primarily because when things get really, really slippery, though in fixed income, those things get killed, they have no liquidity. We'd rather be buying them when things really, really deteriorate. So, and if 2016 is any experience, I mean, oil and gas bonds traded down to $45, as did metals and mining. So we're basically really, really taking advantage of high grading our portfolio right now.
Okay, so you've kind of already answered my next question. So let's move on to options. So your team utilizes options in the construction of your portfolios. Can you discuss a couple of those strategies and why they're beneficial to investors in your funds?
Yeah, so a lot of fixed income managers don't utilize options primarily because it's not something that a lot of fixed income managers do. Equity options tend to be more prevalent in equity markets. So what we've done, and this was primarily by need, when you're managing money in a mutual fund, it's very, very difficult for you to do things that reduce risk in the portfolio because there's so many restrictions with respect to shorting securities. So if we want to take duration out of the portfolio, it's very difficult for us to short government bonds. If we want to take advantage of buying insurance in the portfolio, I mean, it's very difficult to short credit and do different things that allow us to do that. So what we found is that by using options on the big liquid ETFs that are fixed income dominated, so things like HYG, JNK, LQD, so the high yield or investment grade ETFs, they're large and they're liquid and they have significant options markets on them on a regular basis. So you get great liquidity, you get great transparency. So what we can do is we can either use options on ETFs to lower our duration when we want a lower duration bias, or we can use it to add duration. The other thing that we use options for is that in times of market volatility, like right now, one of the things that we spend a lot of time doing is worrying about what happens if the stock market goes down, what happens to credit. So one of the things that we constantly build into the portfolio is a little bit of insurance that if the equity markets draw down, we expect that the high yield ETF will go down, the investment grade ETF will go down. So what we do is we do option strategies on that to benefit from when those ETFs go down. So they're kind of like an insurance policy against the credit that we own. So that's a little bit of what we do. We always like to have, especially in times like now, when volatility gets really, really low, we have an ability to do a lot of these things at a very low cost. So we continue to add a little bit of hedges to the portfolio when we start worrying about things, which is exactly where we are in the cycle right now. The other thing is that say a big sell-off happens and we want to take advantage of emerging markets, or we want to take advantage of high yield, or we want to take advantage of Europe, it's very difficult to go out and buy securities that when they've been really distressed, because typically nobody wants to sell them to you because they're too cheap and nobody wants to issue them. So we found that by using large, liquid, diversified ETFs we can get fast exposure to high yield, investment grade, European credit or emerging markets, and we can get that portfolio exposure really quickly without having to wait for it to be issued. And then the last thing is we typically, not typically, but we will selectively enhance our portfolio yield by collecting premium on options against positions that we have in the portfolio. So it's very similar to what people do on equities covered calls and things like that we'll use.
Okay, so on a pretty different topic, in meetings that I have with advisors, I almost always get questions about floating rate securities. What can you tell us about that segment of the market right now?
So good question. And my lunch meeting today, that's what everybody wanted to talk about was again. So I think when people ask me about floating rates, what you're really asking me about is rate resets and preferreds. So we don't own any prefs right now for a couple of reasons. So the first reason is liquidity is horrible. The second reason is that when we think about, if we look at this chart that I have, it's the BMO ladder preferred shared index, which is primarily rate resets. What we find is that when you're in an environment where banks are cutting rates, you don't want to be in a floating rate security, primarily because most of these things either trade off of short-term rates or they trade off of 5 years. And if we're in an environment where central banks are cutting rates, and I think that the 5-year could basically go below where it went last time, below 50 basis points, you don't want to be in something that basically is going to float over something, because as we saw, the last go around, they're going to get killed. So a lot of people have said, Mark, these things have already been killed. And I agree. When I look at things like Enbridge at 7%, and I look at some of the other stuff at 6%, and some of the banks at 5.5%, I agree. But my point is simply this: if the Bank of Canada cuts rates, as I said, 2-3 more times, if 5 years go through the old low of 50 basis points, that index is going to go to an all-time low. And the problem with it is when people start redeeming out of this ETF, they're not going to be able to sell those old rate resets. They're going to sell the new rate resets. They're going to sell the things with the floor. They're going to sell whatever they can. The baby will get thrown out with the bathwater. So I agree right now with everybody, they're cheap, but I think they're going to get cheaper. So I'm very leery about anything that floats right now. Again, when I like to buy this stuff is when things are going the other way and central banks are raising rates, that I know, every quarter I'm going to get paid more, as opposed to the risk of getting paid less.
Okay, so I'm going to just have one more question and then we can wrap up. So can you talk about your outlook for returns for the remainder of 2019 and into 2020?
Yeah. So I think that, as we talked earlier, I think that easing by central banks is going to be a major theme this year. And as I said, we've had 24 cuts by central banks so far this year, and I think that's going to continue to be the theme. So where you want to be right now is duration. So I think that right now we're going to be in an environment where duration really, really pays off. And if you look at most bond funds, they're having an exceptional year right now. I mean, this could probably be one of the best years ever for fixed income. So I think that, again, like I said, could we be up 7% or 8% this year? It's a possibility if rates keep going the way they are. I mean, that's amazing for a bond fund. It's far exceeded what I thought was going to happen this year. So, I mean, as I said, I think this year is going to be pretty good. I think with respect to the economy, I agree we're slowing, but I don't think there's a chance of recession this year. I think it's a 2020 story, and it may be second half of 2020. So if central banks cut this year, we don't have, we just continue to slow. We don't go into a major downturn. I think that things, like I say, I think this will be a great year. 2020 is going to be an incredibly tricky year to navigate. So for a couple of reasons. So the first thing is that as soon as we get a sniff of recession risk, high yield market's going to sell off because the equity market's going to sell off. I think we're going to have, investment grade will get pulled down with it because it's credit. And then what we're going to continue to get is this, probably broad selling from ETFs. And then we're going to be finally testing this liquidity on these ETFs. So a lot of them have been constructed with a lot of different products, and it'll be really interesting to see how the market handles it when the selling comes and when people say, well, I don't want this ETF, I don't want that ETF. So I think things are going to be very, very tricky. So even though central banks and even though Bank of Canada and Fed will be cutting rates, what you're going to be earning on your duration, you're probably going to be losing on your credit exposure. So the real trick will be to balance those two things and basically live to fight another day, that when things get really stressed, that we can basically turn the portfolio around, find some great opportunities, recycle that shorter dated cash that we have, take our duration back down, because maybe at that point governments or central banks are going to be going the other way. So like I said, I think 19 has the potential to be one of the best years, and I think 2020 is going to be tricky, but I think at some point there's going to be a great opportunity.
All right, thanks, Mark. That's all the questions that I have. I want to thank everyone for joining us. We'll send you links to the information that we looked at today. And if you have any questions for Mark, please send them to us and we'll get them answered for you. Again, thanks for joining us, and have a great day, everyone.